onto the market when the New York traders are gone for the day and there is no liquidity in the marketplace. And it hits stops because there's no one there to fill the order. So it just triggers stops all the way down. It's a drive-by shooting. The interesting part about it was that Michael Lynch, I believe is his name. I think that's his name. An analyst who talks about the Colmex says, there was interesting movement when the price got slammed down. Two American commercial banks came in and bought massive amounts. It was Bank of America and Morgan Stanley. They came in and literally silver went right back up and gold came up about halfway because it had hit so many stops on the way down where funds that use algorithms to, trigger sell limits or sell orders just fall. The interesting part about Morgan Stanley and Bank of America is you have the chief investment officer, of course, of Morgan Stanley. It's well known now that said, sell half your bonds and put 20% of your assets in gold.
And this is the point at which Jordy Visser fundamentally alters the entire narrative. Because although most retail investors are blaming BlackRock, the ETFs, and the purported Wall Street conquest, he contends that this tension does not indicate the demise of Bitcoin. It indicates the maturation of Bitcoin, the stable price movement, persistent fluctuations, and relentless volatility that appear deliberately orchestrated. According to Jordy, it is merely the natural outcome when a trillion-dollar asset class shifts from a retail-driven aspiration to a globally integrated financial system. Indeed, it is a disagreeable sensation. Yes, it appears to be slower in comparison to the previous post, which was characterized by euphoria. However, Jordy asserts that Bitcoin cannot realize its full potential without the involvement of these new participants, as they are the ones bringing it from the periphery into mainstream application. And paradoxically, the very forces that people currently criticize will be the same forces driving Bitcoin's ascent once the next wave emerges, particularly as artificial intelligence and blockchain technology converge into a unified economic framework. Let us return to the video.
I think that there are a lot of things at play when they knocked it down. The answer is yes, but I think you have to examine what happened when they knocked it down. I mean, it got knocked down in 2 days. You saw in both instances, a couple weeks ago, you saw massive amounts of gold and silver dropped in what's called the access market. It started anyway at a period of time in between New York closing and Asia opening. There's no liquidity in the market there. And when this happens, it would be the worst possible time to ever do it. In fact, there wouldn't be a trader on the planet that would ever do it. If they did, they would be fired and shot, and probably not in that order, as you're dumping copious amounts of gold and silver onto the market when the New York traders are gone for the day and there is no liquidity in the marketplace. And it hits stops because there's no one there to fill the order. So it just triggers stops all the way down. It's a drive-by shooting. The interesting part about it was that Michael Lynch, I believe is his name. I think that's his name. An analyst who talks about the Colmex says, there was interesting movement when the price got slammed down. Two American commercial banks came in and bought massive amounts. It was Bank of America and Morgan Stanley. They came in and literally silver went right back up and gold came up about halfway because it had hit so many stops on the way down where funds that use algorithms to, trigger sell limits or sell orders just fall. The interesting part about Morgan Stanley and Bank of America is you have the chief investment officer, of course, of Morgan Stanley. It's well known now that said, sell half your bonds and put 20% of your assets in gold. And then Bank of America lead analyst Michael Hartnett is saying, yeah, make that 25% in gold. And so these two banks came in and gobbled it up. But when you look at how this has tremendous strength and resiliency, I look back over my career, Adam, and any time that the market got hit this hard, they'd step on its neck and it would never come back. Everyone was saying, this is it, it's over. Gold broke 4,000, silver broke 50, the bull run is over, sell your gold. It never left, and it was done. If when the media said that, they said, by the way, the the start of this massive sale happened when no rational trader would have ever done it. It was dumped in the middle of the night when there was no liquidity. This would have been done over hours or days during New York trading, not bang when there's no one there. If they would have said that, I think the market may have looked at things a little bit differently. Oh, I see. And then two big U.S. commercial banks who have changed their allocation recommendation to gold came in and scooped up physical on the cheap. There are a lot of games going on, bottom line. And I think you just have to have strong fingertips and see the bigger picture. But I think there are a lot of banks and a lot of big players who were off sides in a very big way. And you could argue it was dumping in order to cover short positions and an opportunity for other banks. I don't know. All I can tell you is that there is no rational explanation to dump it at a period of time when there's no liquidity in the market. You would do it judiciously, slowly in New York trading. And again, to your point, it's also important to remember that even with this sharp correction, when you talk about silver, it's up over 65% this year. And gold is up over 50% this year, even with these pullbacks. But to me, it's not even as much who or why as it is what. Why would anyone do that? There's just no possible explanation for why anyone would dump it at a period of time to trigger all of the selling. It's a drive-by shooting. It's done for effect. Maybe it was rescuing stale short positions for one entity or an opportunity for others. But the bigger question is why even do it to begin with? It would be the least opportune way to maximize this massive gain that you would have had if you're selling, unless that's not what it was. I mean, when you talk about at the institutional level, I would argue that you're running into serious supply constraints. I mean, you look at the central banks and their numbers are usually backed up a little bit, but in September, they bought 39 tons of gold, which was up 79% month over month. And it's the highest month of reported net buying in 2025 so far. And you're continuing to see massive amounts of gold bought across the board. You look at Tether. Now, I've talked a lot about Tether and their role in the stablecoin legislation and how they are buying gold and Bitcoin with their profit. Their numbers on their third quarter balance sheet are almost 13 billion in gold.
Now that China has designated silver as a resource of national strategic importance, the market must be understood in a different light. This designation signifies several practical realities: potential export restrictions, prioritization of domestic industrial needs, and possibly state-led accumulation via intermediaries. When a nation capable of consuming 1/3 of the world's annual silver production begins to tighten its control, volatility on Western markets appears superficial, concealing a more profound structural scarcity. The discard and buyback behavior described by Andy aligns precisely with the market in which physical metal is discreetly being depleted while the paper price remains controlled. And this is the point at which silver's distinctive characteristics become significant. It functions concurrently as a monetary metal and an indispensable industrial resource, particularly in solar, electronics, and energy grid applications. China leads in the production of all three. If the leading global solar manufacturing nation seeks assured, continuous availability of silver, it must acquire the metal promptly, proactively, and without inciting hysteria. That is exactly why these nighttime sell-downs, followed by a surge in tangible offtake, appear so suspicious. You do not amass strategic resources during peak periods. They are accumulated during episodes of dread. This reflects the conduct of a consumer contemplating 2030, rather than focusing on the immediate chart.
They're buying gold hand over fist. Wow. When they issued these stable coins, to back whatever it is that they're doing, they're backed by U.S. Treasuries, and the interest on those treasuries is not transferable moving forward. And they will put more and more into gold. They were just at the Beaver Creek Mining Summit, so they're dealing directly with the miners now as well. And so I think whether you're talking Tether or the central banks or the massive deliveries into COMEX or the massive deliveries in Shanghai, at the highest level, you're seeing a rush, a quiet rush for physical possession, huge amounts. And I don't know, I just think that this inventory problem will only get worse. Now, it's ironic that we haven't seen it as much on the retail level, but we're beginning to in certain areas. And I don't know if there's any coincidence or just it's the inefficiency of the U.S. Mint, but the U.S. Mint, the product availability is horrid and the premiums are out of control. Right now on Gold Buffaloes, you're going to pay about $300 over spot to buy a Gold Buffalo. They're as rare as hen's teeth all of a sudden. American Eagles, $200 over. Silver Eagles, $7 or $8 or $9 over. I mean, the premiums are all of a sudden on U.S. Mint products. They haven't made a Platinum Eagle in years. As a side note to all of this, you want to kind of draw a line between conspiracy and reality. I would urge everyone to go to Road to Ruda's website or to YouTube channel, Big Swear, and watch his 3-part series with a man named Jack Sermon, which was done a couple of years ago. I remember almost falling off my chair hearing it. Jack is the guy that developed the Eagle program for the U.S. Mint, and under Janet Yellen, he said he was told by his superiors, who would have been Janet Yellen, the head of the Treasury, to only mint as many Silver Eagles, the fewest amount possible, without creating a global revolt. He admits this, and he's been at the mint since '86, since they started doing it. There's no question that the U.S. Mint is by far the hardest mint to get product from reliably, in my opinion, at a reasonable price. But I wonder, is it starting to spill down into this side of the market, because you're beginning to see people wake up, not the thousands of sales, everyone buying, tiny little bits, but on high levels, we're seeing very, very, very large orders, and a lot of it in gold. What does it mean? I'm not quite sure, but simply to say at the top, it's not getting any better. Is it starting to trickle down? Yeah, maybe it is, but it hasn't reached Main Street yet.
In the treasury of the stablecoin company?
Yeah, and I'm going to talk about something else also. Now, again, maybe I've been stupid to say things, or maybe I'm just courageous enough to say what I believe. I don't know. There's a fine line between that and that. But, there is a fine line between conspiracy and reality, and I've learned that the hard way over the years. Now, Bo Hines was Trump's crypto czar until August, and now he just happens to be the CEO of USA Tether, which is already Genius Act compliant.
Mm-hmm.
Now, if you wanted, as I've been saying for a long time, to bring back manufacturing, the only way to do it, because of Triffin's dilemma, is to shed the reserve status and devalue the dollar. Everyone's talking about the debasement trade. Even mainstream is talking about the debasing of the dollar. Well, the way to do that is to revalue gold. So what if he says to Bo, all right, Bo, with all of the interest that you get, you're going to buy Bitcoin, you're going to buy gold. You're going to use Bitcoin to pay off the debt. You're going to buy gold to devalue the dollar. You have a major player now who will be moving every time money moves, and the backing of it by stable coins has to be bought by U.S. Treasury. That's the one-to-one peg. It's the Treasuries and dollars, but it is the interest that is not transferable on those treasuries. It can't.
Mm-hmm.
They're not giving the stablecoin holder the interest. Instead,
right. They
they're
do
buying
something with that
gold.
interest, so they're buying
Yes,
gold. But,
yes.
But so, and again, this is me just thinking this through in real time. So I see how that benefits the corporate owners of Tether, because hey, we're getting a lot of gold, right? It's not benefiting the stablecoin holder per se, except I guess it makes Tether maybe more solvent. How does that help with the devaluation of the dollar?
Because the higher the price of gold goes, the lower the value of the dollar. So in other words, when you measure the dollar falling 7 or 8% against a basket of crappy currencies this year, the dollar index, measure it against gold and see where it is. It's down 50.
So let me just interrupt you then. So are you saying that the sort of on a stealth way, the government actually wants the price of gold to rise versus the dollar?
Yes, I do believe that. It is the only way you will ever be able to reshore manufacturing is to devalue the dollar. When when Roosevelt devalued the dollar or confiscated gold at $20 an ounce, he then devalued the dollar by 40%, making it $35.
And he had to do the confiscation before he revalued. A different thing this time around. Yeah.
Correct. And I really do believe that is what they want to do. Now, is there an arrangement for the Treasury to buy that gold? I don't know. It wouldn't surprise me when you put Bo Hines in there. It's no different than putting Stephen Mirren in the Fed, who is the architect of the Mar-a-Lago Accord, which again speaks to a devalued dollar. And you talk about gold revaluation, it's not a conspiracy theory. I mean, read the Genius Act. I think Section 9 or Section 10 talks about next year they'll revalue gold. Now, some say market to market. James Rickards is going around saying, I think he says 24,000 is the number he comes up with. We don't know what that number is, but raising gold to that level not only devalues the dollar substantially, but gives the Treasury General account a huge boost of free money that would come in the form of selling or giving the gold certificates to the Fed, and they just print money out of thin air and give it to the Treasury. We can go into how that works if you want, but the bottom line is it devalues the dollar. It gives a large sum of money to the Treasury that can work down its debt. And then you throw in Judy Shelton pegging the back end of the bond market. You bring back manufacturing at no upfront borrowing costs. Is it the way to do it? I don't know any other way besides full-on default or hyperinflation. This is kind of a third option, soft default on the dollar.
Okay.
And, but one last thing, you look at I'm going to butcher the name of this, Kyrgyzstan. Yeah, their government has just officially registered a U.S. dollar. It's USDKG as a stable coin, pegged 1-to-1 to the dollar, and fully backed by gold reserves under state control. And so we're seeing gold move into the monetary system, and that's the bottom line. Whether the central banks, the commercial banks, the massive deliveries into COMEX, these people that are bringing in billions upon billions upon billions upon billions every month for the last year, since last November, they don't do this just for the hell of it. And as you've noticed, since all of this gold's been coming into the country, isn't it interesting to see that gold is up 50 plus, 60%? Right. They don't do it just for the heck of it.
Yeah. All right. So I got to ask to make sure I heard you right on this. Did you say that in the Genius Act, there actually is a clause in there that talks about intentionally devaluing gold?
No, there's revaluing gold. Yes, there is a clause in there about revaluing gold.
Revaluing gold.
Yes,
Okay.
Revaluing
gold, meaning at a much higher rate than
either marking it to market because it's on the U.S. government balance sheet at $42.22 an ounce.
Okay.
Either remarking it to market, or as others say, Mike Maloney says 10,000. He uses M1. Rickards has a different metric, says 24,000. Right. Who knows where it goes to? But
the fundamental insight here is straightforward. Price volatility has become a preoccupation. The strategic ascent of silver aligns with the trajectory that gold followed when central banks transitioned from sellers to purchasers between 2008 and 2010. Prior to that shift, gold was regarded merely as a commodity for trade. Following its designation as a reserve, silver is at the forefront of that same transition, not due to a sudden increased affection from central banks, but because the world's leading industrial consumer acquires it for national development and cannot afford supply disruptions. That is why every discrepancy in delivery holds significance. Each month of abnormal contract corresponds to delivery issues. Each short-term price decline is significant. These are no longer merely indicators for speculators. They are indicators of physiological duress experienced during a strategic stockpiling cycle. When metal transitions from Western exchanges into private or state-controlled entities, it does not return. The inventory pool diminishes, leverage ratios fluctuate, and the forthcoming surge of demand, whether originating from institutional investors, sovereign entities, or industrial purchasers, impacts a supply chain that has become more fragile and less resilient. For investors, the implications are significant. Silver has evolved beyond merely serving as an inflation hedge or a speculative investment. It is increasingly regarded as a geopolitical asset, a supply risk asset, and a technological dependency asset. These categories command higher valuations than basic commodities due to their association with national priorities rather than investor sentiment. If worldwide industries compete with national accumulation, retail investors are the final in line, and the price mechanisms respond accordingly. This is why the designation of silver in China should be regarded as the most significant development for the metal in over a decade. It shifts silver from being a valuable industrial metal to a strategic resource with implications at the state level. This indicates that future supplies may be protected, redirected, or withheld in times of geopolitical tension. It indicates that volatility will increase as paper markets attempt, but ultimately fail, to accurately reflect the genuine scarcity of the physical metal. And it implies that long-term investors should consider access rather than solely focusing on price. If you seek a comprehensive analysis of China's classification, its impact on global supply chains, and its implications for silver pricing through 2026, please share your thoughts in the comments. If today's analysis has clarified Andy Schmann's insights, similar to this video, please subscribe and activate the notification chime. This marks the commencement of the most significant structural transformation in silver observed in recent years. We appreciate your attention and look forward to our next video.